Bitcoin hit an all-time high of $126,198 back in October 2025. Today, it's trading around $63,000, down almost half. That drop alone can gut a retiree's nest egg or wipe out someone who bought in late chasing the top. So, who's actually eating this loss right now? People like Sonia, 62 years old, put $40,000 into crypto last year as part of her retirement plan. That $40,000 is worth roughly half of what it was. And here's the number that explains why. Six major tech companies just issued almost $250 billion in bonds in 6 months, more than double all of last year. That's the trigger behind everything we're about to walk through. Okay, that's a lot to unpack already. Stick with us. Let's do this in three parts. First, how Bitcoin and gold earn their reputations. Second, the $250 billion signal and what it actually means. Third, why the money's moving out of one asset and into the other right now. Part 1. The reputations. Thesis. Bitcoin was sold as digital gold, but better, independent of the stock market, fixed supply, faster growth. Gold got stuck as the boring backup, the thing your grandfather owns and never talks about.
Because gold doing 3% a year can't compete with Bitcoin doing 300%.
Right, and that's the whole reputation gap in one sentence. For over a decade, every time Bitcoin ran up, gold got mocked as a dead asset. Financial YouTube was full of it. Why hold a metal in a vault when you can hold something that 10x's in a bull run? So gold just sat there the whole time? It sat there, steady, unglamorous, occasionally moving 1 or 2% a year while Bitcoin made headlines. And that's exactly why nobody was watching it when things started to shift. Implication: when everything's calm, boring loses attention. When things get scary, boring is exactly what people go looking for. So part 1 is basically exciting wins in good times, boring wins in bad times. Got it. What changed? Part 2, the $250 billion signal. Thesis: that bond number isn't just a big figure, it's a warning sign. Big bond volumes usually mean leverage, and leverage between companies means dependence on each other staying healthy. That combination is exactly what creates fragility. Wait, walk me through that. Companies borrowing money to pay other companies. A chunk of the AI boom right now runs in a loop. One company pays another for chips or cloud capacity. That company turns around and invests in the first one. Both book it as growth on paper, even though very little new money actually entered the system. So if one link in that loop stumbles, the whole loop feels it. That's exactly why analyst Ed Zitron has compared a stumble at a major AI company to a Lehman Brothers moment, not because the products are worthless, but because the financing is concentrated and circular. How concentrated are we talking? Roughly a third of the entire S&P 500, the 7 biggest tech names make up an estimated 34 to 35% of it based on recent index weighting data. If your retirement account tracks a basic index fund, a third of it is riding on 7 companies and one story. That's Sonia's other exposure too, probably, not just her crypto. Exactly why this hits harder than a normal stocks went down story. She could be diversified on paper and still concentrated in reality. So what does it actually look like if this loop breaks? Paint the picture. Say one hyperscaler misses a growth target investors were counting on. Its stock drops, which pressures the value of the deals it made with its financing partners, which pressures their balance sheets too, since a lot of this is leveraged. Lenders get nervous, credit gets tighter, and companies that were fine on paper suddenly can't roll over debt as easily. That's a leverage unwind. It doesn't require anyone to do anything wrong, just for growth to slow down a little faster than the debt assumed it would. That's a genuinely uncomfortable scenario. It is. And to be clear, that's a plausible risk, not a prediction. Nobody knows if or when it happens. But investors don't wait for proof before they start moving money. They move on the possibility.
Part 3, where the money is actually going. Thesis: it's flowing to gold, not Bitcoin. And the reason is about correlation, not hype. Quick definitions, because these numbers get thrown around without explanation. The gold to Bitcoin ratio just measures how many Bitcoins it takes to buy an ounce of gold. When that ratio rises, it means gold is gaining ground on Bitcoin. It's up roughly 7.5% in the last 2 weeks. And the fear index is a 0 to 100 score of investor sentiment. Anything under 30 signals real fear, not caution. Bitcoin's is sitting at 28. So both numbers are pointing the same direction. They are. Here's the part that stings for anyone who bought Bitcoin as a safety net. It was supposed to move independently of the stock market. Lately, it's been moving with it, rallying when risk appetite is high, dropping right alongside tech stocks when fear shows up. It's correlated with the exact bubble people are nervous about, instead of protected from it. So it hedges nothing when you actually need the hedge. That's the core problem in one line. Gold doesn't have that issue. No earnings report, no CEO, no dependency on a circular financing loop staying intact. And central banks have been steadily buying it for years as part of reserve diversification. Slow, long horizon money that doesn't panic sell in a rough week. Is that new, or has that been happening a while? It's been building for a while, but it's picked up noticeably as more institutions started treating gold as insurance against exactly this kind of concentrated, leveraged tech story. Not because they think AI is worthless, but because they don't want their whole portfolio riding on it staying perfectly healthy.
So it's less gold is exciting now, and more gold is the one thing that doesn't care what happens to that loop we just described. Exactly that. Quick pause. If you were Sonia right now, would you actually swap some of that 40K from Bitcoin into gold? Drop your answer in the comments and tell us at what price you'd make that move. We're genuinely curious how many of you would pull the trigger versus just wait it out. So, here's where this leaves us, so far at least. Bitcoin was marketed as the modern, uncorrelated alternative to gold. Right now, in the middle of the exact kind of fear it was supposed to protect against, it's trading like just another risk asset. Gold, unglamorous, unexciting gold, is quietly picking up ground while that plays out. Not because gold suddenly got smarter, but because Bitcoin, this cycle, started acting like the thing it was supposed to protect you from. And for Sonia and anyone in a similar spot, that's not a small distinction. It's the difference between an asset that cushions a bad year and one that makes a bad year worse. So, tell us, are you holding Bitcoin, gold, both, or neither right now? And after hearing Sonia's situation, has anything here actually changed how you're thinking about your own money? We read every comment.